You've probably heard the phrase "no tax on Social Security" repeated a lot over the past year. But here's the question nobody answers clearly. Is that actually true, and does it apply to you? The real law that passed doesn't do exactly what the phrase suggests, but it does deliver real relief to the vast majority of seniors, an estimated 88%, according to the White House. Let's break down exactly what the law says, who actually qualifies, and how to check if you're one of them. What the law actually does. Here's the most important fact to understand right away. The law does not repeal the tax on Social Security benefits. The underlying tax code provision that allows Social Security to be taxed is still on the books. What actually changed is different, and honestly, it's a bit more complicated than the slogan suggests. The law in question is called the One Big Beautiful Bill Act, signed on July 4th, 2025. Instead of eliminating the Social Security tax directly, it created a new temporary deduction, $6,000 for individual taxpayers age 65 and older, or $12,000 for married couples where both spouses qualify. This deduction is available for tax years 2025 through 2028. Here's how it works in practice. This deduction stacks on top of your existing standard deduction. For many seniors, that combined deduction amount ends up being larger than their taxable Social Security income, which means their federal tax bill on those benefits effectively drops to zero. That's where the no tax language comes from. Not because the tax was repealed, but because the deduction cancels it out for most people. Who actually qualifies, so who gets the full $6? Deduction? According to the law, you need to be age 65 or older, and your modified adjusted gross income needs to be under $75,000 if you're filing as an individual, or under $150,000 for married couples filing jointly. Real quick, if you haven't already, hit subscribe now so you don't miss next week's update, then let's keep going. If your income is above those thresholds, the deduction doesn't just disappear all at once. It phases out gradually as your income rises. According to tax analysts, the deduction phases out completely for individual filers earning more than $175,000, and for married couples earning more than $250,000. Based on this structure, according to the Council of Economic Advisors, roughly 88% of seniors receiving Social Security income will end up paying no federal tax on those benefits. That's up from about 64% before this law passed. But that also means the remaining group, roughly 10 to 12% of beneficiaries, mostly higher income seniors, will still owe some federal tax on their Social Security income, just like before. Let's make this real with an actual example. Say you're a single senior receiving the average Social Security retirement benefit, which is roughly $24 a year. Combine your regular standard deduction with this new $6,000 senior deduction, and for most people in that income range, the total deduction exceeds their taxable Social Security income entirely, resulting in zero federal tax owed on those benefits. Now take a married couple, each receiving that same average benefit, a combined $48,000 in Social Security income for the household. With the $12,000 combined senior deduction stacked on their standard deduction, they also end up owing nothing in federal tax on that income, as long as their total income stays under the phase-out thresholds. But here's a different scenario. A single senior with $90,000 in modified adjusted gross income, which is above the $75,000 threshold. Their deduction would already be partially phased out, meaning they'd likely still owe some federal tax on a portion of their Social Security benefits, even under this new law. The political context stated fairly, I want to walk through this part carefully, because there's real debate here, and both sides deserve a fair hearing. Supporters of the law, including the Ways and Means Committee, point to the fact that this delivers real, measurable tax relief, describing it as $63 billion in tax relief for seniors, and noting it helps offset years of rising costs that hit fixed-income retirees especially hard. Critics, on the other hand, point out that the law technically doesn't fulfill the literal promise of no tax on Social Security for everyone, since the underlying tax still legally exists and still applies to higher-income seniors. Some Democratic lawmakers, including Senator Ruben Gallego and Representative Angie Craig, have introduced separate legislation called the You Earn It, You Keep It Act that would attempt to permanently and fully eliminate the tax on Social Security benefits for everyone, rather than using a temporary income-limited deduction. It's also worth noting, for full context, that some analysis from the Tax Foundation points out that both this deduction approach and full repeal proposals would add to the federal deficit, since less tax revenue would flow into the Treasury either way. What you should actually do. So here's your action plan. First, figure out where your income falls. If you're a single filer under $75,000 or a married couple under $150,000 in modified adjusted gross income, you likely qualify for the full deduction, and combined with your standard deduction, You may owe little to nothing in federal tax on your Social Security benefits. Second, remember this deduction is temporary. It's currently set to run through tax year 2028, not permanently. If you're doing multi-year retirement income planning, factor that expiration date in rather than assuming this rate is locked in forever. Third, when you file your taxes, expect a new form. According to tax professionals, this deduction is reported using a new attachment called Schedule 1A, added to Form 1040. If you use a tax preparer, they should already be accounting for this, but it's worth asking directly to make sure it's applied correctly to your return. And finally, if your income is close to the $75,000 or $150,000 threshold, it may be worth talking to a tax professional about legitimate ways to manage your taxable income for the year, since even a small difference near that line can affect how much of the deduction you receive. So to sum up, no tax on Social Security isn't a literal repeal of the tax, but it is a real $6,000 deduction for seniors 65 and older that, combined with the standard deduction, brings the federal tax bill to zero for an estimated 88% of beneficiaries. If your income is above roughly $75,000 individually or $150,000 as a couple, you may still owe some tax, and that's worth planning for. Either way, understand exactly how this works, not just the slogan, puts you in a much better position when tax season comes around. If this video helped you understand what this law actually means for your taxes, hit subscribe, because I break down real Social Security and Medicare updates every single week. Official facts, no scare tactics, no guessing, no political spin. And let me know in the comments, does this deduction apply to you, or does your income put you above the threshold? I'll see you in the next one.